Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is EOG Resources, ticker EOG. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. First up, we have the market cap of $84.8 billion, enterprise value of $83.4 billion. So you have about $1.4 billion in net cash on this business, which is actually really nice. I like seeing businesses that aren't leveraged with debt, and so this would mean that they have more cash than debt if they have any debt at all. They're operating the oil, gas, and consumable fuels industry, which tends to be a relatively poor industry, but that may or may not play out when we look at the numbers. So they explore, develop, produce, and market crude oil, natural gas, and natural gas liquids. Principal producing areas in New Mexico and Texas, Republic of Trinidad and Tobago. So it had net proved reserves of 3.7 billion barrels of oil, 1.5 billion barrels of crude oil and condensate reserves, 829, natural gas, 8.2 trillion cubic feet of natural gas reserves. That sounds like a lot. And it was formerly known as the Enron Oil and Gas Company. Not surprising why they changed their name if it was associated with the Enron. Incorporated in 1988, headquartered in Houston, Texas. So 1.5 beta means that they're about 50% more volatile than the average S&P 500 company. Not surprising for an oil and gas company. The return on invested capital chart instantly tells us a few things that are not surprising. Because it's in the oil and gas industry, you can clearly see the cyclicality in this business model. Anytime you see waves in the return on invested capital chart, that's tracking the earnings, of course. And so it's telling you that, you go from 3% in 2002 up to 27% in 2005, 2007 down to 15, up to 25%. You can see where the bottoms were in 2009. 1% is a 2010 bottom. 3% in 2012. You get back up to 12% in 2014 before losing money in 2015, 2016. They lost money in 2020. Now, they only lost money in 3 years of the last 20 years, which is actually pretty good for an oil and gas company. But you can just see the sheer volatility about this. The problem that I have with charts like this for return on invested capital is it's unpredictable. It's not that it's bad. It's not that it's good. It's that it's unpredictable. I don't know what the future looks like. If the future looks like this, where you spend, let's look from 2002 to 2008. You have 7 years here, and only one of them is a bad year, 2002. The down part here in 2007 of a 15% return on invested capital is actually a pretty good number. If this was your future, that would be great. If this was your future, that would be poor because you have a lot of bad years. And it's not even so much the more years good, more years, less years bad or something like that. It's just that you can't predict the future. What do you think your return on invested capital is going to be 3 years from now? You have no idea. And that's why this would be a below average company based upon this chart. And that's surprising in the sense when we look at our 10-year median returns, we have a return on invested capital of 10%. That passes my threshold. I like to see 10% or higher. We see 10.6. Return on equity of 14.3%. That's really close to my 15% target. All these numbers look good, especially when you consider that it's a net cash business. It's just the problem is we can't predict the future. So even though the last year here is really good, 17% return on invested capital, you just don't know what it's going to be. Now, when we look at valuation, the valuation starts to look really interesting. PE of 11.4. Even poor quality companies can be good values at the right price. Anytime you get under a PE of 15, they start to get interesting, especially when you combine a PE of 11 with an EPS growth rate of 14%. That starts to look really attractive, especially you're seeing revenue growing faster than assets. That means you're getting more effective with your assets. And of course, EPS growing faster than revenue means you're getting some operating leverage. Now, I think where I might have a problem is, again, back to this cyclicality. What I want you to see here is just the sheer changes in revenue in terms of the down years. From 2014 to 2015, you have a negative 48% change in revenue. Any time you can have a 48% drop in revenue in a single year presents massive problems for a business. Because what happens is you have something like this, where you would go from $11,000 in gross profit to $4,000 in gross profit, which is a 70% decline in gross profit, and it sends your operating profit negative. That sort of movement is devastating to a business and makes it really hard for managers. Not only that, but you follow it up with another decline in the next year, and then you have 50% growth for 2 years in a row. How do you plan a business around this sort of growth? And you can't really. It's all based upon changing prices of oil and natural gas, and makes it very difficult. look at the change here from 2020 to 2021. You basically grew 100% year over year, and it made a massive change. You're at a 14 billion gross profit because you've had such a massive growth rate. I mean, if you just look at your EPS growth, you went from $1.05 per share to $8 per share. I mean, you ate extra earnings over a decade. That would be amazing if you didn't have these years of losses, because you have a single year of losses in 2015, loss of $8, that completely wipes out this amazing year in 2021. Likewise, you have this year in 2016, which wipes out a couple years as well. So when you have losses like this, it makes it really difficult to analyze the business, and you can't just look at this most recent number. So like this $8 per share, we're trading $141. I mean, our trailing 12 months numbers must be substantially higher than that. Yeah, $12 here. So this price is probably actually really expensive unless what the current earnings are can be sustained out into the future. If you're enjoying this video so far, hit that like button. Don't forget to subscribe. We're about to dive into the income statement and balance sheet, and I hope you'll stick around for that. So, income statement. The SG&A has doubled from 3.3 billion to 6.7 billion. And problem here with the SG&A is it's really hard to manage it. Now, they're doing a good job of managing their SG&A down during these bad years, but it's just very difficult. I mean, very unpredictable. It's hard to manage a business like this. I know I've said it repeatedly, but that's something that's going to be a big negative when you're thinking as an investor. Because even though, look, these numbers are amazing. I mean, we said we doubled from 2020 to 2021, and your trailing 12 months is up to 28.9 billion. I mean, you're absolutely massive operating leverage here. I mean, look, the cost of goods sold is basically flat. And so all this money is dropping to the bottom line. You're getting really, really amazing returns this year. I mean, these returns are going to be significant to get this $7.5 billion in profit. The problem is just how sustainable is that? You've never seen that before, so you should expect to decline back towards average. Now, you have seen as well that the shares outstanding have been increasing over time. You're up about 5 to 8%. It's not a significant amount. It's going to be less than 1% a year, so I don't have a huge concern about the dilution there. Some of the companies I like that I own do have dilution, even though it's not preferred. But as long as you're keeping it below that 1% a year, that tends to be acceptable in my book. Let's look at the balance sheet. One thing that's really interesting here is you've not actually increased your PP&E that significantly. You've gone from 21 billion to 28 billion. So the PP&E is up 30 to 40% over the course of a decade. But again, I mean, you've 7 extra operating profit, you've 12 extra net income. If that was sustainable, this would be absolutely amazing. I think the problem that I have is I don't believe it's sustainable. Let's look at our long-term debt. So 5 billion. So your long-term debt is flat. That's actually a really good sign because you've actually paid for your PP&E with internally generated cash flows, which you don't always see in a lot of these companies I look at. So I really like that. And that 5 billion in debt is being offset by your 5 billion in cash. So that's good as well. That's allowing you to have your net cash position. What you can see is that for most of the last decade, you've not had a net cash position. You actually got up to 7 billion in debt at one point, but you've paid that down. You've been generating so much cash in recent years that you've been in a really good position. Let's see. You've doubled your shareholders' equity. That's been good. You can see that growing asset base. So the balance sheet actually looks really good for this business. You don't always see this for oil and gas operators. So this is a pretty good oil and gas operator from what I'm seeing. Pretty high cash flow from operations. You can see all this giant amount of depreciation made, 3.6 billion, somewhere in that $3.5 to $4 billion range of depreciation and amortization every year is being offset by a lot of investment as well. So you should expect maybe the depreciation to rise a little bit over time, but you can see all the money they're having to throw into additional PP&E. The nice thing is that they are covering it with their cash from operations. You don't see them issuing tons and tons of debt. There is some years where you raise debt. There's years where you pay it down. I really like seeing that. It looks like they paid a one-time dividend almost in 2021. That's actually a really good sign. And in fact, you probably did the same thing in 2022. These are really good signs for shareholders anytime they pay special dividends, because that's exactly what this looks like, is some special dividends. That means that the business managers recognize they don't need all of that excess cash. They're paying it back to shareholders. You really like seeing that. The dilution seems to be coming from the stock-based compensation because you do have some buybacks. They're just not offsetting the stock-based compensation. I don't like stock-based compensation in an oil and gas company, but again, they're keeping it relatively low to the size of the business, so that's okay. It's tough. There's nothing an oil and gas company is going to be able to do about the cyclicality in their business. This is just how the business works. However, with the recent results and the way they've been able to manage their gross profit, the way that they've been able to manage down SG&A, you don't see this at a lot of companies going from $4.5 billion to $2.7 billion in SG&A. That's very well managed in how they're managing it so that they don't just have massive losses in those years. I really like how this business is being managed. If you're interested in oil and gas companies, this would be something that's worth a little looking at. Do you think current prices are sustainable? If so, this company could be very, very interesting. That's not something that I project myself, which is why it won't go on my watch list, but the future could be very, very bright if they can sustain what they've been doing recently. They have net cash. This business is not at risk of imminent failure because their debt is low compared to their market cap, compared to their enterprise value. With the cash that they have, they can pay it off if they wanted to. They're producing a prodigious amount of cash every year. So I think it's a really interesting company, and I hope you've enjoyed this video. Hit that like button. Don't forget to subscribe. Ring the bell so you get notified as I upload new videos each and every week. I've already put out 160 S&P 500 companies. I think you will enjoy them. So please hit that the link to the video at the top at this end of this video. And if you like this software, quickfs.net, I encourage you to check it out. My affiliate link is the first link in the show note in the description below, and tell them that Trey Henninger sent you, and that would be a great way for you to support this channel without sending me any money. You can get a free or a paid account, and I get a commission when you sign up. So I would really appreciate that. Thank you for listening, and until next time, stop paying fees, start building wealth.